Have you ever noticed that time is one of the most important aspects of our lives? It's literally a fundamental component. Well, in trading, time also plays a decisive role. The time frames you choose determines not only your approach, but also how to see the market. Many understand this point, but the time frame is the very foundation. When you open a chart, you might not think that the trends you see on it depend entirely on the chosen time interval. That is, if you switch between time frame tabs, you will see completely different charts, different support and resistance levels, and different signals for opening trades. But first, let me tell you what a time frame actually is. It's the coordinate system. It's the reference point you'll rely on when making decisions. From setting up indicators, receiving signals from them to identify chart patterns and trends by eye, a time frame is a simple tool that allows you to look at the market as if under a microscope, or conversely, from a bird's eye view. You can draw an analogy with a map. On a small map, you can see the entire city, but it's hard to make out the details. If you zoom in, you'll see every street, but you'll lose the big picture. Choosing the right time frame helps you see exactly the right map you need. For example, if you're planning a short-term trade, you won't need a monthly chart because it will have too much unnecessary information. Conversely, if you want to see the overall trend and direction of movement, looking at minute-by-minute fluctuations is pointless. Of course, like other tools, time frames have types. They can be divided into three groups. First, short or small time frames. Charts with 1, 5 and 15-minute intervals. They show the slightest market movements, opening opportunities for quick entries and exits. Second, medium time frames. From 1 hour to 4 hours. They filter out random fluctuations, but retain enough detail for precise entries. And the third, long-term frames. Daily, weekly, monthly. Charts show long-term market trends. Extra noise is completely filtered out. Only significant movements remain. A competent trader knows how to combine different time frames. For example, they look at a daily chart to understand the overall trend, and then switch to an hourly or a 5-minute chart to choose an entry point. It's very important to understand. The choice of time frame depends not on the platform, not on chance, but on you, on your temperament, how much time you have, and how you want to interact with the market. There are traders who love activity, dynamics, constant movement. Shorter time frames are closer to them. And there are those who value regular, calm analysis, rarer but more considered decisions. But they often work with medium and long-term intervals. To make it clearer for you, let's break it down in order. Short time frames are for those who love speed. Decisions are made quickly, there's almost no time for long contemplation, there's a lot of noise, and the slightest movement can be confusing. You need to filter out unnecessary information. If you want to control everything and react to every move, then this is your option. But beginners often get carried away and start opening too many trades in a row. This leads to loss of focus, and the result becomes chaotic. So, if you're just starting out, you shouldn't immediately jump into the smallest time frame. Medium time frames, a balance between detail and the bigger picture. Now imagine you set a time frame for 1 hour or 4 hours. Here you see the market moving in a certain direction, but you don't miss local changes. There are advantages to this because you can analyze the situation more calmly. Suitable for those who can devote a few hours a day trading but don't want to sit at their chart non-stop. A good option for beginners because there's less chaos here than 1-minute charts. And long time frames, strategy and patience. Daily, weekly and monthly charts are a different level. With them, you see global trends, understand where the market is heading overall. There's less unnecessary noise. Short-term fluctuations are smoothed out. You can't jump in and see everything immediately. Here, sometimes you have to wait a long time. Long time frames are suitable for those who perceive trading as part of a strategy, not a constant screen time. And here you might have a question. How do I understand which time frame is right for me? But before I tell you how to correctly choose a time frame for yourself, I want to make a short pause to invite you to my Telegram channel. There I share additional materials that will help you reinforce what we discuss in the videos. You'll find strategy breakdowns, tips on using a demo account, useful charts, and answer to common beginner questions. There, you can ask questions, discuss your observations, and get support. The link is in the description down below under this video, but be sure to check it out. It will speed up your development in trading. And now, let's return to our discussion. Actually, there is no specific answer because it's individual for everyone. But we can highlight 3 factors that will influence your choice. First, your lifestyle rhythm. How much time do you have for trading? If you can only spare an hour in the evening, minute charts are unlikely to suit you. It's better to choose a medium or long time frame. Second, your temperament. If you are a calm person who prefers to analyze everything and wait, then medium or long time frames are better. If you love dynamics and want to be in the motion, then try short ones. And third, your experience. I would advise beginners to start with hourly charts. There's less chaos here than on a minute chart, but you don't have to wait for weeks. Speaking for beginners, many at the initial stages make a very common but serious mistakes. For example, switching timeframes too frequently. Beginners often jump around. 1 minute today, an hour tomorrow, then a day later, there is confusion. You need to decide and work within your system. Also, trying to find the perfect time frame, it doesn't exist. It's like looking for the perfect time of day to exercise. The main thing is regularity and habit. And lastly, ignoring higher time frames. Many only look at small charts and think that's enough, but without the bigger picture, your decisions will be random. So friends, let's sum up. We've covered what a time frame is and why it is the foundation of your understanding of the market. You've seen how to correctly choose intervals to see the market as a whole, filter out unnecessary fluctuations, and make decisions calmly. A time frame is your tool for analysis, from setting up indicators to understanding trends and chart patterns. We've considered 3 groups of time frames: short for quick reactions and dynamics, medium for a balance between detail and overall picture, and long for strategic approach and patience. You've understood that a competent trader knows how to combine different intervals, a higher one for the general trend, a medium one for clarification, and a lower one for precise entry. But the main thing is, the choice of time frame depends only on you, your lifestyle rhythm, temperament, and experience. Beginners are most often advised to start with hourly charts because there's less chaos here, and you can calmly observe the market. We've discussed the most common mistakes beginners make: switching timeframes too often, searching for the perfect interval, and ignoring higher timeframes. By avoiding these pitfalls, you can work systematically and confidently. If you want to reinforce the material and speed up your learning, I invite you to my Telegram channel. There you will find strategy breakdowns, examples of working with a demo account, useful charts, and answers to beginner questions. The link to the channel is in the description down below, and go ahead and use this tool for your development. A time frame is not just numbers on a chart. It's your coordination system, your reference point, your key to understanding the market. Regularly analyze, try things out, record results, and build your individual approach. And then working with the market will become conscious and your decisions confident.